Hey guys, Q here from Hyperstocks. Today we're going to be talking about the RSI, or the Relative Strength Index. Now I'm going to give you guys the definition. This is right off Investopedia. The definition looks like here is a momentum indicator that measures the pressure of the recent price change that evaluates whether a stock is overbought or oversold. Now, that may sound confusing because it's not on a chart, it's an actual definition in words, but don't worry, we're going to go through it and we're going to break it down for you. All the RSI does, and this is probably one of the most popular, this is one of the most popular indicators that are out there. All it does is it measures if a stock is overbought or oversold, and it also gives us positive and negative divergences, which I will also go through with you guys. So first of all, I want to break this down. The RSI down here, I'm going to go ahead and take it off for now, and I'm going to put it back on. That way you guys are aware of how to put this on your tradingview.com. So if you use tradingview.com, you're just going to go to indicators. You're going to search the RSI, or the Relative Strength Index, and you're going to press this. Now, just having the RSI is not good enough. A lot of people are gonna, ask you to go in and change a couple things, depending on their trading style. Personally, I like the levels 70 and 30, and I'll explain what these levels are. Some people prefer 80 and 20, just depending on your own experience and knowledge. I guess you have different preferences, but all it is that there's the upper band and the lower band, which are going to be right over here where I'm pointing to with my cursor. I have my level here set at 70, and I have another level set at 30, meaning that these are the levels that I want to look out for the RSI to go above or below, for me to know that something's overbought or oversold. So obviously, if something is over 70, now it's becoming overbought. Therefore, demand is going to start slowing down, or technically, it's going to start slowing down. Now, this is just a suggestion that it's going to slow down. Sometimes stocks will skyrocket and stay above that 70 level for quite a while before they come back down. But as a day trader, you want to get out of a stock as soon as you start seeing those signs that a reversal may be coming soon. That way you can secure your profits. So it's good to always have the RSI on. With the RSI being one of the most popular indicators, it also gives you some reinforcement for your trades. Because day trading is so subjective, when you have something that's so popular being used by so many different day traders, it becomes a more solid foundation for reversals, because a lot of different traders and a lot of different eyes, just like you and me, are going to be looking at the RSI to see if something's going to come back down or go back up. So let's go ahead and go back here and give you an example of what an overbought RSI looks like. We're going to go on the USO chart. We're currently on 1 hour candles, and we're going to take a look at this part right over here. So do you see how the RSI was at a good level for quite a while until it started going into the plus 70. This is from 0 to 100, and now it's over 70. And as you can see, as soon as it went over here, it became instantly overbought. Therefore, demand started decreasing at that price. So traders didn't want to pay the $11.50 price anymore. Therefore, the strength of the RSI will start to go down. It'll start to diminish until it finally reaches a level below 30, and it goes back up. Now, this is not set in stone. It's not going to always follow to the T. So you have to keep in mind that you have to use other indicators, your candlesticks, your moving averages, as different methods of trading in total. But the RSI is always something to keep an eye on when you're trading, because it's very important. Let's give you an example of something that's overbought in the RSI. We're just going to go right over here. It's a pretty obvious example. The RSI dips, and then it dips down to the 14% mark, and then it bumps back up as soon as that happens. And then you see this candle at the top right over here with the long wick at the top. That's a clear sign for a reversal, but that's a whole different educational video about candlesticks. But that is just pretty much the overbought and oversold levels of the RSI. Now I'm going to go ahead and explain the positive and negative divergence of the RSI, and this is very important because it's a crazy sign, and I use it all the time for a lot of my trades, where the RSI will give you a positive divergence, indicating that a reversal may be coming, that a bounce in price may be coming. Let me give you the first example, and we're actually going to go back to the same example that I just gave you. I want you to pay attention, and let me go ahead and pull up something to draw with right over here. I want you to pay attention to these levels right over here. If I have a lower low being created by the stock, technically you would think that the RSI is going to follow this to the T because it follows the chart perfectly. However, the exact opposite happens. So this is the low that the stock had made, but the RSI is stronger on the other side when the stock makes a lower low. Now this is what we call a positive divergence. When you see something like this, and it doesn't always happen to the T, it's just a suggestion by the RSI, you should be expecting that somehow that the price of the stock is going to start to go back up because of that positive divergence. Now, negative divergences also happen as well. I want you to pay attention. Let me go ahead and see if I can find a good example for you guys where a negative divergence happens. Yep, right over here. So if you look at the way the stock made a lower low right over here, wait, I'm sorry, that's another positive divergence, but you know what, let's go ahead and give you this example as well. So the stock makes a lower low and then the RSI makes a higher high, and as you can see, the stock followed through and it went back up, although it made the lower low right here, but the RSI made the higher high. So it's a pretty cool tactic. A lot of people use the RSI strictly for the trading above overbought and trading below oversold. However, you know, the positive and negative divergence are also lifesavers if you know how to use them properly. All right, so I found a negative divergence for us to use as an example, and I'm gonna go ahead and point it out right over here. As you can see, the stock makes a higher high from this point to this point. The stock clearly went up in price. However, the RSI did not follow suit. As you can see, the higher high made right here, and then the stock also makes another higher high right over here, but it dips back down, and then the third time right over here, the stock dips back down as well. So the RSI is not only used for the very next high, you can also go back and use it for comparison of previous highs to see if the stock is going to head down or up. And I will repeat this one more time. It is just a suggestion. You have to know other indicators for you to use the RSI properly, but it is something to always keep an eye on, because even professionals, even fundamental traders out there will look for those signs that we are overbought or oversold in the general markets or a specific stock within itself. Now I want to go back to the recent move on USO. I know we've made another video on USO, but I want to show you how I found the bottom of USO recently. Now developments in the United States oil fund are going to happen throughout the next week, so I'm not guaranteeing this move is going to follow through, but I want to show you how I found that 426 was going to be the bottom of USO, and I did so with the RSI. Now, pretty clearly, right over here, you can see that the stock has been making lower lows for quite a while, but the RSI kept going up, although the stock kept going lower. So this was a clear indicator that the strength in the selling was starting to diminish. And this is perfect when it's combined with different patterns that the stock is showing. So as you can see right over here with my cursor, I'm pointing to a squeeze pattern that the stock was creating right around the $4.20 range, where the RSI was at most high, although the stock was at most low. So that is a perfect example of how you could use the RSI to your advantage to spot reversals and when it's time to sell or buy. Oil right now, or USO, is currently overbought, so we should expect a pullback at any time. However, you want to keep an eye on the RSI from different time lengths. So remember, it's one thing to study the RSI on 1 hour candles, but you also want to look at the 1-day candles to get an overall comparison of just how overbought the stock is. So on the 1 hour candles, it's very easy to believe that the stock is starting to get overbought and it's going to go back down and diminish completely. But if you look at the 1-day candles, it tells you that the RSI is nowhere near overbought. So what does this mean to us as traders? What it means is that when we see a pullback on the stock itself, it's likely going to pull back just to cool off the 1 hour candles. It's not going to pull back to cool off the 1-day candles, because different time lanes need different cool off periods. So where do you stay though? Where is the most common place to stay in terms of time lanes in studying the RSI? I would say as a day trader or as a professional trader, you're going to constantly be looking at the 1 and 5 minute charts. That is assuming that you're doing quick scalps. So if you're doing 1 minute charts, the RSI will tell you different times that you need to go ahead and get out of a stock and go back into a stock. So in this case right over here, as you can see, the RSI on a 1-minute chart had made such a higher high that it needed to pull back, but on the 1-hour chart it was still fine. Therefore the pullback was not so strong. It was just, the stock had gone down by a couple points before going back up, and then eventually cooled off the RSI enough to go back up. So this goes for anything on the market. When you're studying charts, you have to study them from different time lengths. As a professional day trader, you have to be looking at the 1 and 5-minute charts and the 15-minute charts constantly. If you're going to be in a trade for longer than an hour, then you need to be looking at the hour charts as well. If you're looking to be in a trade for longer than a day, then you need to be looking at the 1-day charts. So think of it this way: whatever time length that you want to be trading in, that's the sweet spot for you to be looking at. Or else you're going to shoot yourself in the foot, because you might be seeing a 1-hour candle not be overbought, but you've been in the stock for days, and now the 1-day RSI is way overbought, and it's going to crash and burn, and you're going to lose your profits. So you need to be switching around, seeing the picture from a micro and macro perspective for you to be successful in trading the markets. Either way, I hope this was helpful. I am trying to make more videos as the weeks go by. I'm trying to do one a week. If you guys have any comments or suggestions, please leave them in the comment section below. Please subscribe to the channel. I know we don't have a lot of subscribers yet, but we're working on it. We've been busy creating the courses, creating the chat, and then now it's time to dip ourselves into the YouTube world, and we'd appreciate your support. Again, my name is Q. I'm from Hyperstocks. Thank you so much for watching.